Hello, everyone. Welcome to another episode of Our 2 Cents on Your Dollars. And I'm James Enriquez, proud Roth IRA holder. This is James Credo, also proud Roth IRA holder. And Leo Chang, not a proud Roth IRA holder. Leo.
Because I don't own a Roth IRA, not because I do own it and I'm not proud.
He's already making excuses.
Okay. Well, you know, we get that question a lot, right?
Yeah.
Traditional or Roth? Leo, what say you, sir? How did you end up as a non-Roth IRA holder?
It wasn't because I'd never owned a Roth IRA. I'm a huge believer in them, right? And the benefit of a Roth is one of the reasons why I actually don't have a Roth, right? Because you can utilize what you've contributed into the Roth and not have to worry about penalty, taxes, anything like that. And so I did early on in my career, I did utilize a Roth feature in a 401k I had in my previous employer. And at some point in time, I then utilized contributions I put into the Roth for other needs. I didn't have to worry about, penalties and taxes. So I am a big believer in Roths. I think they are a huge, powerful tool that we can utilize. And the nuances of when and how to utilize them are things that I'm excited to dive into a little bit.
Okay, so other than being able to get to the contributions tax and penalty free, what are some of those other features and benefits that make it so valuable?
I think the main and the best benefit for Roth is tax-free growth and tax-free distribution. There's really nothing else that provides that benefit in both formats.
That's not the way traditional IRAs are? They're not tax-free?
They are not tax-free. No. Traditional IRAs, you're putting money in pre-tax. The money grows tax deferred. So you're deferring that tax liability out over time. And then when you go to take distributions out of that traditional IRA, at that point in time, you're paying ordinary income taxes.
Okay. So Roth IRA is the other way around. It's after tax now and it's tax-free later.
Correct.
So it's not going to help me on my taxes today.
Correct.
Okay.
Correct.
All right. So, Mr. Chang, why don't you have a Roth now?
Well, there are certain stipulations that qualify you to participate in Roths, one of them being income limitations. So if you are filing single, and you make less than $161,000 in 2024, you can make direct Roth contributions. If you are over that amount and you file single, you cannot. If you are married filing jointly, the income limitation is $240,000. So if you make over $240,000 filing jointly, you cannot make direct Roth IRA contributions. So it's a blessing in the case that, we're able to, make a good living as a household. But that's one of the features that restricts us from making direct Roth IRA contributions.
Okay, so are there any other ways to get money into a Roth if you're a high income earner?
Yeah, there are. And one of the easiest ways, and it's funny about Roth in general, it's so awesome that it's one of the most overlooked things out there, But for example, most clients I've seen that if they're working and they have a 401k plan, they actually have access to a Roth 401k account. And I'm often surprised that, they're not aware that they don't have to just contribute into their traditional 401k where you put in money, you get a tax deduction. You can also put into a Roth 401k where it works the opposite way. You're putting in after-tax contributions. It's not going to benefit you today, but tomorrow, everything in that account will be tax-free.
Yeah, I often get two questions from clients about that. One, I didn't even know there was a Roth 401k option.
Yeah.
And two, why make too much money for that Roth 401k option? So are there any income limits?
No, that's the cool thing, is that, it's through your employer. So there's no income restrictions like it would with a Roth IRA. Because Leo mentioned earlier, if you're married and you're making $240,000 and you make more than that, you can no longer contribute into a Roth IRA. But, right here at your employer, there's no income restrictions, and you can put even more. I think for Roth IRAs, on an individual basis, you can only contribute $7,000 if you're not at least 50 years old. But with the Roth 401k, you can put in $23,000, which is significantly more. Yeah, with no income restrictions.
And it has the same tax treatment. It's going to be tax-free later.
Yeah, it's very similar. If you've had the account for at least 5 years and you're 59 and a half, your contributions plus the gains or earnings are all going to be tax-free. So
the other question I get is, this is legit something that happens whenever I ask them to look into if your 401k has a Roth benefit. Oh yeah, it says after-tax contributions, and that sometimes individuals do get confused. There is a difference between an after-tax contribution into your 401k and your Roth contribution into a 401k. An after-tax contribution is treated similarly to a brokerage account where money goes into it after taxes, but the money goes the earnings are growing tax deferred, and when you go to take money out of that account, all the earnings are taxed at ordinary income. Roth IRA, it's growing tax-free. So it is going in after taxes, but the difference is that money's growing tax-free. When you go to take distributions, that money's tax-free.
Okay. So those after-tax contributions, do they count against me for making Roth 401k contributions?
So you have this gets into a different conversation. So there's a thing called a mega backdoor Roth.
Wow.
Right? And so yeah, we're going there. So a mega backdoor Roth is a way for you to really maximize putting money into a Roth 401k. So you have income limitations as far as how much money you can put into your 401k on an annual basis. There's then also limitations in regards to how much money goes into your Roth.
You mean contribution limits, right?
Contribution.
Not income limitations.
Sorry, yes, contribution limits, right. So those contribution limits are the same no matter how much income you make, right? So Credo mentioned earlier, a 401k, you can contribute $23,000 into your Roth portion of your 401k. You can additionally, on top of that, make a contribution along with whatever your employer is contributing into your 401k plan, all the way up to $69,000 a year. That's for 2024, if you're under the age of 50. If you're over the age of 50, you can do an additional $7,500 catch-up. So you can do a $23,000 Roth contribution. You can also do an additional, whatever the difference is, if your employer puts in $10,000, then you have $59,000 that you can technically put in. So you can put in $23,000 into Roth money. The additional amount you can put in as after-tax money. That after-tax money, you can convert that into Roth money on an annualized basis. So that money goes in after tax, then you do a Roth conversion. That money then is converted into Roth dollars. So now you have a much larger amount than that $23,000, a much larger amount than the $7,000 that you can only do into an IRA. That's going in as Roth money, growing tax-free. Your employer contributions that are going into your 401k, those cannot be Roth. So those are always going to be pre-tax contributions that go into the plan. But that makes up a difference as far as how much you can put in total.
I think Secure Act 2.0 might have changed some of that.
Yes, some can go to
the employer contributions.
Yeah.
But traditionally, the matching had to go to the traditional or pre-tax. Yeah.
Oh yeah, that's true.
Okay, but you told me that after tax works a lot like a brokerage account, except that it's going to be the earnings are going to be taxed at ordinary income. So if you do that conversion from the after tax to a Roth, am I going to owe taxes at ordinary income on that conversion?
No. So your after-tax dollar amount that you put in, your tax already on that dollar amount, and then it's going to be automatically converted into that Roth feature.
Okay, so you're saying to convert it before I even invest it.
Right.
Gotcha.
Convert it right away. That's the idea. Because if you convert it later down the line than any of the earnings, then you're going to have a tax situation with whatever earnings you've made on that.
Yeah,
Okay.
there's some 401k plans now that you can actually have it on automatic
Yep.
conversion.
Yeah.
And that's why, it's important for people to look at their actual plan document. For us, there's a lot of cool things in there. That's where we find the features and benefits of your plan, and we get really creative.
Okay. So you mentioned conversions. So can I convert a traditional IRA to a Roth IRA?
Absolutely. Yes.
Okay.
Yeah. And he was talking about the mega backdoor, but he forgot
There's
about
a regular
just a
backdoor.
regular. That's just a regular.
I was
back.
wondering about that.
He went straight.
We got to get excited about after tax and all
Yeah.
that other stuff. So
But but a simpler strategy is that you can make a contribution into a traditional IRA, and you're not going to deduct that contribution, and then you're going to convert that IRA contribution into a Roth, and that's another way to get into Roth money if you're above the income limitation or restrictions.
Okay.
Yeah.
which is so silly, right? That IRS knows this is a loophole or a strategy, and everyone knows this is out there, but yet, we still have these restrictions in regards to income. So to me, it's just a silly concept that we know we can do, but it's still an extra hoop to jump through to be able to make those contributions.
Well, don't antagonize them, Leo. You know what?
If you're watching, I'm not trying to.
This might go viral and get to them. Okay, so that's a backdoor Roth. Is there anything I should be aware of? I understand. What are these pro rata rules that I hear about?
Yeah, you got to be a little bit careful when you have several IRA accounts. You want to make sure that if you're doing a backdoor Roth, that you have one IRA account that you're using to do conversions, because otherwise there has to be a calculation that's going to be made in terms of determining how much of this is taxable across all of your IRA accounts. So you have to really clean it up. You want to make sure you have one IRA account that you're making a contribution into, and then you're converting that account. Otherwise, you're going to have to calculate, the taxes due across all your IRA accounts. So,
Yeah, that's one thing that happens with clients where, they're, hey, CPA says I should make a backdoor Roth contribution. It's normally them working with a new CPA, so they don't necessarily know the full picture. And they don't realize they have additional IRAs, traditional IRAs that hold assets. And so that pro rata rule, which early on I didn't even know was a thing. We've talked about it beforehand as far as just competency and understanding and applying that. But early on I didn't understand that rule. I didn't really realize it was a thing. And then later on, doing more due diligence, there's certain circumstances where you really have to take that into account before making those recommendations.
Yeah, I think there's a couple of points for people that are considering a backdoor Roth. I think one, because of these pro rata rules, I don't know, you might want to consider rolling over your IRA into your 401k if your employer 401k allows it. That way you don't have to, there won't be any trip up of these pro rata rules. And I think the other big thing is the Form 8606, reporting that correctly. Because if you don't have that, it could inadvertently be taxable, that conversion. So that's the back doorway. So if I can convert a non-deductible traditional IRA, could I also convert a regular traditional IRA?
Yeah, absolutely, you could. And, that's something that a lot of clients, that we've helped with, You can definitely convert a traditional IRA into a Roth, but one thing you have to consider is when you do that, it is a taxable event. But just because it's taxable doesn't mean it doesn't make sense. We have clients, in different situations where, for example, they're not even using their retirement assets for retirement. And so essentially their retirement accounts are going to be for their beneficiaries. And so here, and currently I think we're in our still third lowest tax brackets in history.
Yep.
And so if you make an assumption that tax rates will be higher in the future, there's a case there where you start converting your IRAs now at a lower bracket, assuming that rates will be higher in the future for you and your beneficiaries.
Yeah.
So,
yeah, I think that just goes into the planning strategy, right? Us, really taking into account tax situation, income, projected income, what lifestyle individuals are going to have, in retirement, posing probability of tax law changes and marginal tax rates changing as well too. That all plays a part in whether you should consider one or the other. But in most circumstances, man, if you can take out money and not have to pay taxes on it, it's hard to beat.
I mean, the one assessment that we have is as awesome as this hopefully sounds to you, is that we're still finding so many situations where we're a little bit surprised. There's not as many people taking advantage of this as we think they should.
Yeah.
We keep mentioning things like tax-free in the future. I think what happens is, we're still trying to avoid pain. So most people still focus for today. So if they have a choice whether they can have tax-free income in the future or reduce their taxes today, I think from what I've seen, they still tend to lean in terms of taking care of today. So even though this sounds amazing to us, we're still a little bit surprised that not as many people should be taking advantage of these accounts while they're still out there. So.
Yeah. So, and I think if you're one of the lucky few that is taking advantage of it, we actually like to employ a strategy called asset location. So let's say you have a traditional IRA, Roth IRA, and a brokerage account, all different tax treatments. We like to strategically place the potentially high growth investments in your Roth account, still while keeping the same mix of the pie over all three accounts. But we like to try to place those types of investments in the Roth IRA to try to grow that tax-free bucket as much as possible. So maybe you could take advantage of some of these alternative ways to get into a Roth IRA. Maybe you don't even have to. Maybe you can just contribute directly into it. I think another opportunity to get money into a Roth is Roth Simple and a Roth SEP. Those are now available. It's one of the few gifts the government gives us.
I can name. No, I can't.
No.
I can name a couple, but whatever. And even then, I'm not sure if it's really a gift. It might be just to.
We'll probably have to pay for it at some point.
Well, now, right? Yeah. Like that's kind of the point.
Somebody's generation, not ours. Not us.
No, ours. Because if you're putting it to a Roth Simple or SEP, you're paying taxes now.
Oh,
so
right.
Yeah,
we love our country.
So on second thought, it's one of the greatest gifts we can give the government.
Exactly. Giving them their
true patriots is what we are.
We're proud Americans.
Yeah.
So we appreciate you tuning in. That's our 2 cents on your dollars.
Thank you.
Thanks, everybody.
Bye.
Hey, everybody. Thanks for tuning in. This podcast is sponsored by Strategic Insights Financial Planning Group. Click the link below for a free financial planning consultation, and we'll see you guys soon. Thanks again.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.